Have you ever wondered why some dividend investors seem to effortlessly build wealth while others struggle to see any significant returns? It can be frustrating to see your portfolio stagnate while others thrive. If you're looking to join the ranks of successful investors, understanding the common pitfalls of dividend investing is crucial. In this video, I'll show you the top 6 dividend investing mistakes many investors make. I'll demonstrate how much each of these mistakes will cost you in dollars and show you how to avoid each one. In the end, I'll show you the potential return on a $10,000 investment if you avoid all these mistakes. It has the potential to reach a valuation exceeding $1.5 million and pay over $30,000 in monthly dividends. So, stick around and let's get started on your journey to financial freedom using these invaluable tips and strategies, prioritized based on their significance in the Billionaire Investment Guide. The first one is ignoring the payout ratio. Dividend investing can be incredibly rewarding, but one of the most common mistakes investors make is ignoring the payout ratio. The payout ratio is the percentage of a company's earnings paid out as dividends to its shareholders. It's a crucial metric because it indicates whether a company can sustain its dividend payments over the long term. When a company has a high payout ratio, it means that a large portion of its earnings is being distributed as dividends. While this might seem attractive at first, it can be a red flag. A payout ratio that's too high suggests that the company might not be reinvesting enough back into its business, potentially hindering future growth and hence the dividend growth itself. On the other hand, a low payout ratio indicates that the company is retaining more of its earnings, which can be used for expansion, debt reduction, or other strategic initiatives. One crucial aspect to consider is the industry in which the company operates. Different industries have varying standards for payout ratios. For instance, utility companies often have higher payout ratios due to their stable earnings, whereas tech companies might have lower payout ratios to fuel rapid growth and innovation. Understanding these nuances can help you make more informed decisions. Let's take an example to understand the impact of ignoring the payout ratio. Suppose you invest $10,000 in a company with a 90% payout ratio. Initially, you might enjoy high dividends, but what happens if the company's earnings decline? With such a high payout ratio, there's little buffer to maintain the dividend payments, leading to a potential dividend cut. Imagine the company's earnings drop by 20%, reducing its ability to pay dividends by the same amount. Your anticipated $900 annual dividend, assuming a 9% yield, might suddenly shrink to $720. Furthermore, the market might react negatively to the dividend cut, causing the stock price to fall, resulting in a double whammy of reduced income and capital loss. On the other hand, consider investing the same $10,000 in a company with a more sustainable 50% payout ratio. If the company experiences the same 20% earnings decline, it can still cover its dividend payments comfortably, potentially even maintaining or slightly adjusting them without dividend cuts. The lower payout ratio provides a cushion, reducing the risk of sudden income drops and protecting your investment's value. Another common dividend investing mistake is chasing high yields. One of the most enticing aspects of dividend investing is the allure of high yields. However, chasing high yields without proper analysis can lead to significant financial pitfalls. High dividend yields can sometimes be a red flag, indicating underlying issues within the company that might not be immediately apparent. High yields can occur when a company's stock price drops significantly while maintaining the same dividend payout. This situation often signals financial distress, potential dividend cuts, or a lack of growth prospects. It's crucial to understand that a high yield does not automatically translate to a good investment. Let's consider a simple example to understand the dangers of chasing high yields. Let's say you invest $10,000 in a stock with a tempting 12% yield. Initially, you might be excited about the $1,200 annual dividend income. However, upon deeper investigation, you discover that the company's earnings have been declining and the high yield is a result of a plummeting stock price. If the company faces financial difficulties and decides to cut its dividend by 50%, your annual dividend income would drop to $600. In other words, cutting your expected returns in half. Additionally, the stock price might continue to decline due to negative market sentiment, leading to capital losses. If the stock price drops by another 20%, your initial $10,000 investment could be worth only $8,000, further eroding your total returns. In contrast, consider investing the same $10,000 in a company with a more modest 4% yield but strong fundamentals and steady growth. This company might not offer the same immediate high dividend, but it's more likely to maintain or increase its dividend over time. Now, in the end, I'll show the potential return on a $10,000 investment if you avoid all these mistakes. Instead of losing money chasing high yields, it has the potential to reach a valuation exceeding $1.5 million, paying over $30,000 in monthly dividends. Our next most common mistake is overlooking dividend growth. Dividend growth is one of the most important, if not the most important factor in successful dividend investing. Unfortunately, many investors overlook this aspect, focusing solely on current dividend yields. However, a company's ability to grow its dividends over time can significantly impact its investment returns and financial stability. Dividend growth refers to the annual increase in dividend payments by a company. Companies that consistently grow their dividends demonstrate financial health, strong earnings growth, and a commitment to returning value to shareholders. These companies often have solid business models and competitive advantages, making them attractive long-term investments. First, it helps protect your income against inflation. As the cost of living increases, so does your dividend income, maintaining your purchasing power. Second, dividend growth can lead to capital appreciation. As a company increases its dividends, it often attracts more investors, driving up the stock price. Another benefit of dividend growth is the potential for increasing your yield on cost over time. Yield on cost is calculated by dividing the annual dividend by the original purchase price of the investment. As dividends grow, your yield on cost improves, providing a higher return on your initial investment. Let me explain the importance of dividend growth with an example. Suppose you invest $10,000 in two companies. Company A has a high current yield of 6% but no history of dividend growth, while Company B has a lower yield of 3% but a consistent annual dividend growth rate of 10%. In the first year, Company A provides $600 in dividends, and Company B provides $300. However, over time, the power of dividend growth becomes evident. After 10 years, Company A still only pays $600 annually because it doesn't grow its dividends. In comparison, Company B's dividends grow to approximately $700 annually because it grows dividends by 10% every year. By the 20th year, Company B's dividends increase to about $1,800 annually, surpassing Company A's fixed $600. Moreover, the stock price of Company B is likely to have appreciated due to the increasing dividends, while Company A's stock might remain stagnant or even decline if it fails to grow its business. Ignoring dividend growth can result in missed opportunities for both income growth and capital appreciation. By focusing solely on high yields without considering growth potential, investors may end up with lower total returns over the long term. But dividend growth alone won't make a difference if you make the next mistake, which is not reinvesting dividends. One of the most powerful strategies in dividend investing is reinvesting your dividends. Not reinvesting dividends can significantly hinder the growth of your investment portfolio, but by reinvesting dividends, you can take advantage of the compounding effect, which accelerates the growth of your wealth over time. When you receive dividend payments, you have the option to either take the cash or reinvest it back into additional shares of the same stock. Reinvesting dividends means that each dividend payment buys more shares, which in turn generate their own dividends. This creates a snowball effect where your investment grows at an increasing rate. Let's look at an example to understand the impact of not reinvesting dividends. Suppose you invest $10,000 in a dividend-paying stock with a 5% annual dividend yield. If you choose to take the cash dividends, you would receive $500 annually and your initial investment would remain at $10,000. Over 10 years, you would collect $5,000 in dividends, but your investment principal would still be $10,000. But if you reinvest the dividends, your investment grows significantly. Assuming the same 5% annual yield and an annual stock price appreciation of 3%, your investment would benefit from compounding. At the end of 10 years, your initial $10,000 investment could grow to approximately $20,000. This growth includes both the reinvested dividends and the appreciation of the stock price. The power of compounding has effectively increased your total return by a substantial amount. And this growth is even more compounded if the company grows its dividends. Assuming the company grows the dividends by 10%, the same investment after 10 years will be valued at around $25,000. And this effect multiplies as you give it even more time to grow. You see, not reinvesting dividends means missing out on this compounding effect, resulting in lower long-term returns. The difference can be significant, especially over extended periods. Reinvesting dividends is a straightforward way to enhance your investment returns and build wealth more rapidly. In the end, I'll reveal how this investment strategy can help you reach a $1.5 million valuation that pays over $30,000 in monthly dividends. Even though you'll be using drip strategies with stocks known for their dividend growth, the stock market, like any other investment, does not always move in an upward trajectory. There's an inherent risk to investing, including the possibility of downturns, which brings us to our next mistake: the lack of diversification. Diversification is a fundamental principle of investing that helps mitigate risk by spreading investments across various assets. In the context of dividend investing, a lack of diversification can expose you to significant risks, including sector-specific downturns, company-specific issues, and broader market volatility. Diversification means holding a mix of stocks from different industries, sectors, and geographic regions. By doing so, you reduce the impact of poor performance in any single investment. For example, if one sector experiences a downturn, the positive performance of investments in other sectors can help balance your overall portfolio returns. Suppose you invest $10,000 entirely in a high-yield utility stock because of its attractive dividends. Initially, you might enjoy a stable income, but what happens if the utility sector faces regulatory changes, increased competition, or environmental challenges? These factors can significantly impact the sector's profitability, leading to potential dividend cuts and stock price declines. So, if the utility stock you invested in drops by 30% due to sector-specific issues, your $10,000 investment could shrink to $7,000, and the company's dividend might be reduced or even eliminated entirely. This lack of diversification in this scenario would result in substantial losses and reduced income. But if you diversify your $10,000 across multiple sectors, such as technology, healthcare, consumer goods, and utilities, if the utility sector underperforms, the gains from the other sectors can help offset the losses. For instance, if your diversified portfolio includes a technology stock that appreciates by 20% and a healthcare stock that gains by 15%, these gains can mitigate the impact of the utility sector's decline. Lack of diversification can expose your dividend portfolio to significant risks. By diversifying across different sectors, industries, and geographic regions, you can reduce the impact of poor performance in any single investment. A well-diversified portfolio not only helps protect against losses, but also enhances your potential for steady income and long-term growth. Remember, the goal is to create a balanced portfolio that can withstand market fluctuations and deliver reliable dividends over time. Speaking of time, the next mistake investors make is only having short-term focus. It's a very common mistake that can undermine the long-term benefits of dividend investing. Dividend investing is inherently a long-term strategy that requires patience and a commitment to holding investments through market fluctuations. A short-term focus can lead to impulsive decisions, such as selling stocks during market downturns, which can negatively impact your overall returns. Dividend investing relies on the compounding effect, where reinvested dividends generate additional dividends over time. This compounding effect is most powerful when investments are held for the long term. Short-term thinking can cause investors to miss out on these benefits, as they might sell their investments before the full potential of compounding can be realized. Let's get back to the previous example and combine all the strategies that resolve our mistakes. We saw that at the 10-year mark, our investment was valued at around $25,000. But if you stayed in it for the long term, the same investment after 20 years is projected to be valued at $118,000. And in 30 years, it's projected to be valued at $1.5 million, paying around $400,000 in annual dividends or roughly $34,000 in monthly dividends. The substantial growth and increased returns of this investment over the long term are both due to the power of compounding, especially when using a dividend reinvestment plan or DRIP. Compounding means that the money earned from your investment makes more money over time. With a DRIP, the dividends you earn from your investment are used to buy more shares. These new shares then earn their own dividends, which are also reinvested. This creates the snowball effect, where your investment grows faster and faster. Over 20 or 30 years, this repeated reinvestment greatly increases the total value of your investment and the amount of dividends you receive. The longer you stay invested, the more noticeable this effect becomes, resulting in much higher returns and bigger dividend payments. Would you like to know a step-by-step guide on how to make a portfolio with actual stocks that pay over $30,000 in monthly dividends? Click the video on the screen to find out.